Welcome back everyone, and in this video, we're going to discuss the 7 stocks that you should keep your eye on this week. Over this next week of trading, most of the largest companies in the world are releasing their latest earnings report. And when these mega cap companies share their results, it tends to lead to significant market volatility. And in today's video, we're going to go over a few of the largest growth stocks on the market, as well as some blue chip dividend payers. And for each of the 7 stocks, we're going to go over their current financial position and take a look at analyst estimates for the earnings that we will see later this week. But before we jump into the first stock, if you're new to the channel, I am the Gen Z investor, and every single day we talk about the stock market, going over different stocks you can buy and sell, and discussing any major market news or headlines. So please hit the like button, subscribe to the channel for daily videos about the stock market, and now we're going to jump right in to the first stock that reports earnings this week, which is Apple, the largest company in the world with a $2.34 trillion market cap, and this company is also the largest holding in my personal portfolio as well. I own 101 shares of Apple with a market value of over $14,000. And if we take a look at their performance, over the past year, the company's up 75%, and over the past 5 years, they have grown 448%, which is absolutely incredible. And they report their latest earnings this week on January 27th, and we are expecting a record-breaking quarter. This may be the first time Apple reports $100 billion in revenue for a 3-month span, which would be insane. They just released their newest iPhones to close out 2020, and analysts are predicting a record-high quarter for their top line. The actual revenue estimate comes in at just below $103 billion, with earnings per share expectations of $1.41. And if we take a look over the previous 4 quarters, Apple has beaten analyst expectations each and every time. And over this latest result, we're expecting 13% year-over-year growth, followed by 40% and over 20% in the next 4 quarters in the future. So Apple has a very strong history of beating analyst expectations, and I do believe that they will do so over this latest quarter as well, which we will receive on January 27th. But one thing I want to share is this $100 billion metric. I believe that this is just a psychological mark that will help determine the success or failure of Apple over the previous 90 days. Even if the company reports $98 to $99 billion in total top line, which is still a significant year-over-year growth rate, if they fail to hit that psychological point of $100 billion, I actually believe the share price will see a decline, making a nice buying opportunity for this leader in the tech space. But if they can hit over $100 billion of total top line, in that 90-day span, we may see share price climb even higher and set new record highs. So definitely a company to keep on your watch list and have your eye on over this next trading week. And Apple does pay out a slight dividend. It is tiny starting yield at only 0.6%. It makes up only 20% of their net income, and they grow it averaging close to 10% annual dividend growth over the past 5 years. And I do believe this 10% average dividend growth will continue for many years in the future, especially when they bring in the amount of money that Apple does, maintaining such a low payout ratio. So definitely take a look at Apple this week, the leader in the tech space, the largest company in the world, and of course this is my largest personal holding, so I'll be watching Apple and definitely following along with their latest earnings presentation. So now we're going to jump in to the second stock in today's video, which of course is Tesla. They report earnings this week as well, and everyone knows this company. It is one of the best performers in the world and is now in the top 10 largest companies in the S&P 500 with an $802 billion market cap, and the company currently trades at $846 per share. On the 12-month chart, the company's up 643%, which is absolutely insane. And analysts are predicting a strong quarter from Tesla once again because of their high delivery numbers they reported in Q4 of 2020. And similar to Apple, Tesla reports their latest earnings after market close on January 27th. We have a revenue estimate of $10.4 billion and EPS expectation of $1.03. And over the past 90 days, analysts have bumped up their EPS expectation 10 separate times. And if we take a look over the previous 4 quarters, we have seen 4 consecutive beats on EPS estimates, and over this latest report, we're expecting 148% year-over-year growth, followed by 284%, followed by 158%, followed by 71% for the next 4 quarters in the future. So analysts have huge growth rates for Tesla in their earnings over this next year of 2021. And if we take a look at an email Elon sent to his employees back in December, he warned them to focus on profits and to implement cost-cutting measures to improve Tesla's bottom line. He understands that the massive run-up that their share price has seen can all come crashing down if the company fails to remain a profitable business and actually fails to grow that net income as time goes on. And a quote from his email says, "Investors are giving us a lot of credit for future profits. But if at any point they conclude that that's not going to happen, our stock will immediately get crushed like a souffle under a sledgehammer." I love that analogy from Elon Musk, and I think he is right. If at any point investor confidence in the future profitability of Tesla goes away, we may see the share price, after this close to 700% run up, see a major pullback to maybe a more reasonable level. So I think analysts from all across the globe are going to be watching for Tesla's latest report, and we will have to see how this company performs and how the share price reacts to the results they share on January 27th. And now we're going to move along to the third company to take a look at this week, which is Microsoft, another leader in the tech space with a $1.7 trillion market cap. And like I mentioned right at the start of this video, some of the largest companies from all across the globe are all sharing their earnings over the next 5 trading days, and we have a very busy week on Wall Street. So ticker MSFT currently trades around $225 per share, and this is the second largest holding in my personal portfolio as well. I own 44 shares of Microsoft with a market value of just under $10,000. And this leader in the tech space is reporting their earnings on January 26th after market close. And we have a revenue estimate of over $40 billion with earnings per share of $1.64. And similar to Tesla and Apple, over the previous 4 quarters, they have beaten analyst expectations each and every time, and we were only expecting a slower year-over-year growth rate in EPS of 8.43%. I do think they will beat this. I think similar to Apple, they're going to have a very strong fourth quarter. I think as people spend more time at home, their cloud services are going to grow, and the products that Microsoft offers for the new work-at-home environment are only going to continue to increase as the transition to a more stay-at-home economy continues to develop. So if we take a look at their share price, it is up 36% over the past year, but over the past few months, it has really been trading sideways. Not much growth over the past 5 to 6 months, but I think that's okay. I think over the long term, Microsoft will still be a major player, and over the past 5 years, they are up 332%. This company does pay out a dividend as well, currently yielding 1% overall, with a payout ratio of 33% of their net income, and they grow their dividend, averaging 10% annual growth over the past 5 years. So Microsoft is definitely a strong dividend growth company to keep on your watch list this week. And so far throughout this video, we haven't seen anything crazy and don't expect anything crazy for the remaining 4 stocks. We have some of the largest companies in the world, and we've already taken a look at 3 of the top 6 largest in the S&P 500, and some major names continue to round out the remaining 4 stocks we're going to take a look at. And if we jump over to number 4, we have Johnson & Johnson, ticker J&J. They currently trade around $163 per share, and the company is up 10% over the trailing 12 months. Over the past 5 years, they are up close to 70%, and they have been one of the most consistent dividend growth companies we've ever seen in market history. Their total market cap is $430 billion, and their current dividend yield is 2.5%. And this leader in the healthcare space currently trades with a forward PE of 20.5. They report earnings pre-market on January 16th with a revenue estimate of $21 billion and earnings per share expectation of $1.83. And Johnson & Johnson is one of the best dividend growth companies on the stock market right now. They are a dividend king with 58 consecutive years of dividend growth. So that means during good times and bad times, through recessions and depressions, the company continued to pay out and grow their dividend payment each and every year, which is absolutely incredible. Their current yield is a nice average 2.5%, and their pay ratio is only 50% of their net income. They grow their dividend averaging over 6% per year, which is a nice rate when you're starting at a 2.5%, and the company does see significant share price growth over the long term as well. And what's so impressive is for a company like Johnson & Johnson to not only pay out a dividend for 58 consecutive years and to grow it every year, but to maintain a 50% payout ratio over the long term, which means their current dividend and future expected growth is still very sustainable over the long term. I own Johnson & Johnson in my personal portfolio as well. It is one of the leaders in the healthcare space, and I own 21 shares with a market value of $3,434. And with this Dividend King, I am up 22% on my current position. So overall, Johnson & Johnson still a leader in the healthcare space, and I don't believe any other company will knock them out from their market leadership position anytime soon. And now we're going to move right over to the fifth stock in today's video, which is Verizon Communications. Ticker VZ currently trades around $57 per share, and this is one of the only high dividend sustainable companies on the market right now with a 4.4% dividend yield. Their current market cap is $237 billion, and this company has a forward PE of only 11.8. On the 1-year chart, they are down 5%, and over the past 5 years, the share price has grown a measly 22% over that 5-year timeline. But this company is known for their dividend, with the current yield at 4.4%, a payout ratio very sustainable of only 52% of their net income, and they grow it averaging just over 2% per year. This is one of the only higher dividend companies you can find on the market right now where the dividend is sustainable over the long term. With how fast we've seen share prices rise, dividend yields have gone down, and it's tough to find some solid companies that will provide you with nice high consistent income each and every quarter. I own Verizon in my personal portfolio as well, and I'm looking forward to this next week of trading where I might pick up a few more shares. I own 74 shares of this company that has a market value of $4,200, and I love collecting my dividend from this high payer each and every quarter. And if we take a look, they report earnings this week as well on January 26th, and their revenue estimate is at over $34 billion with earnings per share of $1.17. And this is another investor presentation I will be highly following along because I can't wait to learn more about Verizon's 5G expansion, which may give the company some momentum, setting the share price even higher than where it is today. So now we're going to jump away from Verizon and move into two final growth companies, number 6 and number 7, in today's video. And coming in next is, of course, Facebook. They are one of the largest companies in the S&P 500 as well. Ticker FB, they currently trade around $274 per share, and the company has grown by 24% over the past year, and similar to Microsoft, somewhat trading flat over the past 5 to 6 months. Their current market cap is $780 billion, and they trade at a forward PE of 28.9. Over the past 5 years, the company has grown 180%, and they still remain the market leader in the social media space. Their acquisition of Instagram around a decade ago, plus Facebook, allows them to have hundreds of millions of daily active users across all of their platforms worldwide. And if we take a look at their earnings expectation, we're expecting revenue to come in at over $26.4 billion and earnings per share of $3.20. And over the past 90 days, we've seen 16 upward revisions of EPS and only one single downgrade. So over the past 90 days, analysts are actually getting more bullish on this latest report, bumping up their earnings expectations for Facebook. Over the previous 4 quarters, they missed by 1 cent, then they beat by 1 cent, and then over the previous 2 quarters, Facebook has crushed analyst expectations, and that's really because analysts were predicting a ton of small and medium-sized businesses to stop advertising on Facebook, really hurting the company's bottom line. But that really didn't happen to the extent that analysts were predicting, so Facebook posted some huge numbers, crushing what analysts were predicting over the previous 2 reports. And over this one we're expecting this week, we're expecting 25% year-over-year growth in earnings per share, followed by over 20% for the next 2 quarters in the future as well. I think Facebook is still a leader in the tech space. We already know that because of their market cap, but I think going forward, people are actually underestimating where Facebook can go. Their platforms are extremely powerful. The company has been acquiring a lot of smaller tech startups, adding them to the Facebook ecosystem. Their overall research and development has been performing very well. And I think as a whole, regardless of what's going on with the government and their intervention into Facebook, I think this company will still be a main player for many years in the future. And now finally, we're going to jump over to the 7th and final stock that you should take a look at this week, and that is Visa. They currently trade for around $202 per share, and this high growth company is actually in the red by 3% over the past year. If we take a look over the past 5 years, they have grown 177%, and their current market cap is $472 billion. They trade at a forward PE of 37, and their current dividend yield is 0.63%. This company has seen beautiful long-term growth. They own 60+% of the credit card market, and that is absolutely insane. And because of the new digital transformation that we're going through, and the fact that individuals are spending less physical cash at in-person retailers and rather doing their shopping online, using a Visa product to make most purchases, that will just lead to a ton of future momentum for this company over the long term. And one thing with Visa that I love, and I actually own this company in my portfolio as well, is the fact that they have massive net income profit margins. I own 21 shares of this company, and I'm up 10% on this position. And with Visa, their total bottom line and their net income profit margin averages around 45 to 50%. That's insane. As their revenue continues to grow, so will their bottom line at an exponential rate. And they report earnings on January 28th after market close, and our total revenue expectation is $5.5 billion with earnings per share of $1.28. And if we take a look at their current dividend, the yield is smaller to start out at only 0.6%. Their payout ratio is extremely small, making up only 23% of their total net income, and they've been growing their dividend, averaging close to 20% annual growth over the past 5 years, which is absolutely insane. So with these smaller yielding companies, although your starting yield might be small, over the long term, that annual dividend payment is compounding at a massive rate, plus you are getting a ton of share price appreciation while you hold on to these companies as well. So definitely take a look at Visa, the leader in the credit card space, and they report earnings at the end of this week on the 28th as well. So in today's video, we went over 7 of the leaders in the overall market. A lot of these companies are in the top 10 of the S&P 500. No surprises, no smaller cap names this week. These are where the blue chip companies, the companies with strong fundamentals, beautiful balance sheets, are all sharing their latest earnings, and I do expect a ton of market volatility over this next week. I'm looking forward to Apple and the potential for a $100 billion quarter, and I can't wait to take a look at how Tesla performed with record high deliveries to close out 2020. And of course, I'm going to take a look at all the rest of these companies that we mentioned in today's video. My watch list is extremely long over this next week, and I'm looking forward to buying some blue chip companies if we see any dips in the market. So thank you for watching, everyone. I'm the Gen Z Investor. We do this series every single Sunday, going over the best stocks to take a look at for the upcoming week. And of course, these are companies who report earnings, have a product launch, or any major investor presentation that will impact the share price. And right now, we are entering the busiest week of the quarter with regard to earnings report. And I am optimistic that these 7 stocks that we talked about today will post some very strong results, and we may see an increase in share price over the next few weeks. So thanks for watching. I'm the Gen Z Investor, and see you in tomorrow's video.